Hi, I'm Dave, and welcome back to Am I Catching a Falling Knife, the show where we slice through market panic and see if there's value hiding in the wreckage. Today, we're looking at Cisco Systems, ticker CSCO, which has dropped about 10% in the last 2 weeks following its Q2 FY2025 earnings release. Is this a classic value trap, or is the knife finally landing on solid ground? So, what triggered Cisco's plunge? The catalyst was a combination of a revenue miss and cautious guidance for the next fiscal year. In Q2 FY2025, Cisco reported revenue of $13.4 billion, down 12% year-over-year, missing consensus estimates by about $400 million. The company also guided for revenue in the range of $52 to $53 billion, which was about 6% below street expectations. The market narrative in one line: enterprise spending slowdown meets margin compression. For those who don't know, Cisco is the world's largest supplier of networking hardware, software, and services. Think routers, switches, security, and collaboration tools. The bulk of its revenue comes from enterprise and service provider customers, with a growing chunk from recurring software subscriptions. The business is global, but North America accounts for about 60% of sales, which means macro trends here matter a lot. Cisco's structural advantages include scale, a sticky installed base, and high switching costs for large customers. Vulnerabilities: heavy exposure to IT CapEx cycles and competition from cloud-native rivals like Arista and Juniper. Now, the income statement snapshot for Q2 FY 2025. Revenue came in at $13.4 billion, down 12% year-over-year. Gross margin was 62.1%, a slight dip from last year's 63.2%. Operating margin was 25.4%, down from 27.8%. Net income was $2.7 billion, or 0.66 per share. Trailing 12-month free cash flow was $14.9 billion. Cisco sits on $27.6 billion in cash and short-term investments, with $8.9 billion in debt. So net cash is strong. Operating expenses are a mix, but about 60% are variable in the near term, with R&D and SG&A flexing as needed. Let's connect the narrative to the numbers. Cisco's guidance implies revenue about 6% below prior street expectations for FY 2026. With gross margins around 62%, a 6% revenue miss could translate to a roughly 6% drop in gross profit. Because operating costs are only partly variable, operating income could fall by 8 to 12% versus previous forecasts. That's negative operating leverage in action. When revenue drops, profits drop faster. My estimate: operating profit could land 9 to 15% below consensus for the next year, depending on how much cost Cisco can flex. So, how much is Cisco really worth? Let's run a discounted cash flow valuation cross-check. I'm assuming flat to slightly negative revenue growth, down 2%, a modest recovery to 3% annual growth thereafter, operating margin stabilizing at 25%, a discount rate of 9.5%, and a terminal growth rate of 2.5%. Plugging these in, I get a base case fair value of about $48 per share. If the margin pressure persists and revenue growth stays negative, the bear case is closer to $40 to $42 per share. Now, multiple sanity check. Cisco trades at about 12.5x forward earnings, 3.2x EV sales, and 9.8x EV EBITDA. Over the past 5 years, Cisco's median PE has been around 15x, so the stock is trading at a discount to its own history. For peers, Arista Networks trades at 32x earnings and 10x EV sales, Juniper at 15x earnings and 2x EV sales. Cisco's lower multiples reflect slower growth and more exposure to legacy hardware. Here's where knife catchers might set their buy levels. Level 1, $48, anchored to conservative base case fair value. Level 2, $44, pricing in further margin pressure or another guide down. Level 3, $40, deep value/forced selling zone if the thesis worsens. Remember, these are not recommendations, just analytical levels for those planning to catch the knife. That's our breakdown of Cisco's recent drop. Remember, this is analysis, not advice. Always do your own research and talk to a professional before making moves. If you've got feedback or want a deep dive on another stock, hit us up. Next episode, we'll tackle a retail name that's been in the headlines for all the wrong reasons. Stay sharp out there.